Searching and identifying sector stocks using power options to analyze the potential in a particular sector. This question comes in specifically from Jeff. Jeff's emailed me the other day and he says, with the United States and other parts of the world reopening, it seems that the travel stocks would come into play. Using the Power Options software, where you show us your process of narrowing down the field of travel-related stocks, i.e. airlines, cruise lines, bed and breakfast, hotels, and so forth, until you found a good candidate. Then determine which option strategy would be appropriate to use for this trade. And finally, find the best expiration dates and strike prices to put the trade together. Now, first thought, my assumption is that in play means bullish and recovery for these stocks and these sectors that Jeff is referring to. However, Jeff could mean volatile and bouncing around. Likely did not mean bearish, as growth and hopefully positive earnings in the next 6 to 9 months and the next few quarters as things start to hopefully get back to normal, and some of these companies will start actually seeing positive earnings where they have not seen any positive earnings in the last year or so. And that would naturally hope and help to bring up the stock price. But I have to be honest, to us, this is sort of an opposite approach. It doesn't mean it's wrong. It doesn't mean it's a wrong direction to go. But one of the comments Jeff mentioned, narrow it down in a sector industry until you found a good candidate. Using Power Options, Ernie, myself, and the other staff members, we settle on the strategy first, whether we're neutral to bullish, speculative bullish, neutral to bearish, or very speculative bearish. We already have in our minds which strategy we would use based on what our anticipation is of a certain market, a sector, industry, for example. We find the strategy already. Most of us have already narrowed down our trading plan to the 3 or 4 strategies we use most on a regular basis. Again, based on if we're bullish or bearish, what matches our goals, our risk tolerance, our trading plan, and our sentiment. Which option strategy would be appropriate to use for this trade? Now, this is not to say it's a bad approach to use a stock, select a stock, and then say, okay, I'm bullish on this stock the most out of those in this industry or sector, and I'm going to go to one of our tools, the search summary tool, and look at long calls versus at the money bull call debit spreads versus maybe a strangle or straddle if I'm not sure which direction the market's going to go. We have several subscribers that actually use other services, and they get either a recommended bullish stock list or they do a search for their criteria. They want to identify bullish or bearish stocks, and then they come into the Power Options search for the strategy that meets their goals. Import that list and search just against that list for those positions. You could do either or on Power Options. He said, find the best expiration dates and strike prices. That's related to the strategy that you settle on. If you're looking to do income, covered calls, naked puts, maybe credit spreads, you're naturally going to be focused on shorter term, under 30 days, maybe under 14 days out in time. If you're more speculative, bullish or bearish, you're looking to buy calls because you feel the stock might have a significant move in the next 3 or 4 months, or you're buying puts because you feel the opposite, or maybe you're doing those at the money or out of the money, low probability debit spreads looking for a high return, you're going to be looking longer term, maybe 60, maybe 90 days, maybe 120 days out in time as well. So using either approach, we can select a strategy and I'd look for bullish criteria. For example, I could just say, okay, I'm going to look into covered calls. I would go into the search. I'd clear out the filters. I'd select my desired expiration time frame. I'd enter the basic return and downside protection I'd want for the covered call position, max return if assigned, percent return if unchanged, and the downside protection. Other basics I might put in the money or out of the money for my plan. And then I'd go to the lists and select the desired industry or sector that we want to look for. Now, at that point, to narrow it down further, I might enter in other basic technicals and fundamentals. I want to avoid earnings between now and expiration for any sudden surprises. I might look for positive earnings growth, to look for strength in the company. That's going to be hard with these types of positions you're referring to in the sectors we're currently in, because most of them don't have positive earnings at this point. And I'd like to look for a current uptrend that matches the sentiment of the strategy that I'm in. Now, I could do it the other way too. I could just take a sector expectation with a similar approach. I think airlines might move up 4 to 5% in the next 30 days. That type of movement is probably best for those simple income strategies I mentioned: covered calls, naked puts, 1 month out standard collars, bull put credit spreads, in the money bull call debit spreads, which we're going to look at after this presentation. Diagonal calendar spreads might be a good other opportunity. Well, I think hotels may move up 10 to 12% in the next 60 days. Well, higher returns, this might be a longer term speculative position. We might look to buy calls 75 to 100 days out in time, give ourselves more time for the stock to move in our direction. And at the same time, an option I buy that's 4 months out in time is not 4 times the cost of the near-term monthly option. So I get a lower cost per day. Even though I'm paying more up front, I get a lower annualized cost buying further out in time. Of course, we get a higher annualized return selling closer in time, month by month or week by week. And that's why those income plays are under 30 days out in time. Longer term speculative or growth, I might also use that varied put position. Buying the stock, buying the appropriate put 5 months, 6 months, 8 months out in time to control my risk to only 4, 5, or 6% in the worst case scenario, still have upside and the ability to do monthly income against it via selling calls or other income methods. And if we're not sure what the market's going to do, we're uncertain of a market direction, we feel there might be volatility, we might buy an out of the money strangle, an out of the money call, an out of the money put 3, 4 months out in time, and then manage both the calls and the puts as they move up and down. And again, that might be 60 to 100 days out in time, depending on what we're looking for. Now, we're going to go live at this point. We're going to go to PowerOptions, and we're going to look at both approaches. We're going to search via strategy, first against the sector, as I just mentioned. We're going to show you the search by symbol tool for other strategies, depending on what your outlooks is. And I want to use the long option finder to illustrate this discussion I mentioned about if I only have an anticipation of a stock moving up 3 or 4% in the next 30 days or so, long call might not be the best approach. You might lose more time value than the intrinsic value you gain on the position. And why, when we think that it might move up 10 or 12%, that might be the time to consider that long call as well. We're going to take a quick look at the search summary tool also to compare different positions against one another. All right, so let me change my screen here. Fantastic. Slide this over so I can see better. All right, so here we are looking at the PowerOptions suite of tools, of course. And what we want to do first is we're just going to follow along with what we mentioned here with the covered call. So we know what's been happening, okay? These sectors that Jeff had mentioned have been depressed, obviously, because of the pandemic. However, they've also received a fair amount of influx of stimulus money and so forth as well. And the market itself has been investing into the different stocks there. The Fed has been keeping things afloat, and they announced, I believe, 5-6 days ago that they were going to stop doing that slowly over time. But we're thinking that there may be an opportunity as things start to open up. Yay, the summer's coming here in the States and in other places, getting a little warmer. People are going to want to fly now that they can. They're going to want to travel. They're going to want to hit the beach and do other things, see people we haven't seen in a long time. So some of these industries are bound to pick up, is what Jeff's thought is. So how would I find potential positions? Well, I'd go into my desired strategy. We'll just use covered calls as an example. I'm going to go into search. Now, I mentioned previously in the slide presentations that when we go into a strategy selection, it's a strategy that we're comfortable with, that matches our risk-reward tolerance. I don't know Jeff's portfolio size, and I don't really need to. He might not be interested in doing covered calls because he doesn't want to buy shares of stock, or maybe he doesn't want to sell cash-secured naked puts because he doesn't want to put up the full cash-secured amount. That's when I might do a bull put credit or a bull call debit spread, or maybe a calendar spread, quote unquote, poor man's covered call. But this is designed for stocks that you feel are neutral to slightly bullish, going to have a stable or growth of maybe 2, 3, 4% over the next 30 days, 40 days, somewhere in that time frame. As I mentioned, we'll just use covered call as an example. I'm going to scroll down below the listed trades here. We're going to empty the filters out of our default screen. I'm going to set my expiration time frame. I'm going to leave it at all expirations, but I'm going to look for, let's say, 2 to 30 days out in time. So this will take me out close to 1 month. It'll avoid anything that would come up today with only 1 day to expiration, and it will include weekly options if they're available. What are my goals in my portfolio for this strategy? Well, if I think the stock's going to move up 2-3%, I probably want to equal that with the return if assigned, the max return on a covered call position if I get called out. So we'll put in a percent if assigned of greater than 3 and a percent downside protection of greater than 3 as well. What does that mean? That means how far the stock can drop based on the premium I collected before I start losing money on the position. Now, I'm not going to worry about range in or out of the money at this time. I'm not going to worry about delta, maybe minimum option bid price. Okay, let's say that we want to get at least 40 cents or so option premium for the call. I'm going to look at some basic open interest, just a minimum of 10 contracts, open interest, and an option volume today of greater than 0. Now, we want to identify a sector. So we're going to go into the lists field here on the search. Of course, we can include any sector or industry to screen only against that, or a specific stock list, if that's what we want to view as well. Let's go into sectors and industries, and we'll just scroll down here. You've got basic materials. None of these are what we were looking for. Communications, no. Consumer cyclical, not exactly. There's some leisure in here. Travel services, we might screen against those. The consumer defensive ones, energy, I'm just scrolling down here, I'm sorry, healthcare, industrial. So I can go airlines or airports and air services. Let's start off with airlines. And we're just going to submit the search. So what am I looking at right now? Okay, I told the system to go across the universe of optionable stocks to find only those positions in the airline sector between 2 to 30 days out in time that offer at least a 3% return if assigned and at least a 3% downside protection. And I wanted a minimum 40-cent bid price. I don't think that's really filtering it, but we do have to take one other thing into account. Most of these, even though they've been volatile, have fairly low implied volatility. The market knows what we know, is that there's an expectation that these particular sectors might start to move. Maybe my return is a little bit too high. I'm not seeing delta in here. I'm not seeing some of the others. So let's lower our requirement for downside protection just to open up the window a little bit more. But trust me, we're going to close it very quickly too. And we're also going to look at, say, option bid price of 20 cents. Okay, so now we've got deltas in there. It wasn't the bid price. It was the return factor that was just on the cusp there. Some 2.8, some 3% returns, max return if assigned on these covered call positions. Now, what else did I mention? We've got 33 total results somewhere between now and the next 30 days. As I mentioned, we've got 1 week out positions that match our criteria, 2 week out positions, 3 week out positions, 4 week out positions, and more. I didn't quite go to standard July expiration, but we could increase the days to expiration to see that also and open it up even more. But now, I'm in a covered call. It's a neutral to bullish strategy. I want a stock that's stable to moving up in price. Even though my speculation is that this sector is potentially going to grow. That's Jeff's anticipation. That's why we're looking at this example. I want to add in some other things. First off, I'm going to stop in the fundamentals. And I'm going to avoid any stocks that have an earnings between now and the expiration date. I don't think this is going to change the results much. Yeah, I kept it right at 33, simply because most of these have had earnings recently, and their next earnings aren't, I think, out to July or to August. So we're A-okay there. I just don't want any sudden surprises. Now I'm going to go into technicals. We'll come back to fundamentals in a moment. And I could put in an average stock volume, but most of these I know are going to have a good volume, at least 500,000, 750,000 shares per day. Hawaiian Holdings might not, but they probably do. But I do want to look for stocks that are trading in an uptrend, because I am looking for a neutral to bullish strategy. Not alone on my expectation. We'll talk about that more in a moment. But if I'm doing a current income strategy under 30 days out in time, I want the stock to be neutral to bullish. Let's just look for a stock that's trading above its 50-day moving average in this case. Okay, so that took us down to 23. We lost 10. And we lost 10 positions that had matched the criteria. It looks like Delta is one of them, and it probably had duplicate call listings because I didn't filter that out as well. So we lost all of the Delta ones because it's currently not in an uptrend where the others in the industry are. UAL, AAL, Hawaiian Holdings, GOL even also is currently in an uptrend because I need the strategy to match my sentiment. Now, we avoided earnings. One other thing you might do in a covered call position, of course, is depending on your account size, you might limit it if you don't want to look at stocks above $80 or $90. Most of these are below that. But if you had a requirement to just look for stocks under $30 or $40, you'd put that in as well. And I could look for positive earnings growth, just see stocks that have a positive earnings growth of at least 5% or more, and none of them do. So this is how I said I was going to close the door very quickly. That's a common thing I would look for in any of these short-term neutral to bullish strategies I was referring to, the bull puts, calendar spreads, naked puts, standard collar, and a covered call. But in this case, we have to alleviate that one. We have to remove that one because these have not had positive earnings naturally in the last 12 to 15 months because of the global conditions. Now, what am I going to do to isolate further? Now is when you'd start your research and analysis. Now I'd start looking at the stock chart, company information, which stock chart makes me feel most comfortable for neutral to bullish position. I've got multiple strikes on UAL and AAL. Which one is the most profitable? Well, naturally, the one with the highest potential return is going to be the out of the money positions, any of those that came up and still offered a 3% downside protection. Because that return includes not only the premium you receive, but the growth, the intrinsic gain. But if I want it to be more protected because I'm still uncertain, I want to go deeper in the money slightly and look for a higher downside protection, more premium coming in so the stock can fall more before I'm technically losing money on the position. And of course, now if I want to do the same thing, but I wanted to do as we mentioned and look at some of those other things, I wanted to look at the leisure or the hotels. We could just go back into the sector list and change which one we wanted to look at. Travel services, for example. Things like TripAdvisor, and here's Norwegian Cruise. Oh, did I select the right one? I might have picked the wrong one. Travel services, yeah. So here's the cruise lines, but you've also got Expedia mixed in here as well. Now the same approach. Which stock chart matches what I want? Which return versus downside protection matches your trading plan and your risk tolerance? That's what we sort of look for in these situations. How I would approach it first by selecting the strategy I want, whether it's a spread, whether it's a diagonal spread, but I want to put in the criteria that match what I'd want for that strategy first, then sort against the sector, then narrow it down further with the fundamentals to find the stock that's in the trend for the strategy that I want, avoiding earnings between now and expiration, and more. Okay, so that was the first step about using the search tool to filter against a sector industry, and then start using the more information button to further research and analyze which one of these has the chart pattern that you want. Check the news always. Make sure there's, I'm sorry, I didn't go to the right one. Company information news. Make sure there's no recent headlines that might cause you hesitation to enter one of these positions. And then you could go further into that as well by analyzing different aspects of, sector performance, analyst estimates, things of that nature here as well. Now, if you did decide that you looked through maybe your broker's service, your broker's tools, and you found that you feel that UAL is the best performer. This is not me, I'm not saying this, but you felt suddenly that UAL is the best performer in that airline sector, and you've gauged that you want to do maybe a calendar call or a debit spread. The easiest thing to do in that case is just go into the calendar call, and instead of going into the search, maybe just go into the search by symbol, and you can just screen for the stock one at a time. And we could set our near-term expiration day. Maybe I'll just use July. And how far out I want to go. Let's go at least to November, maybe October in this case. UAL might not have October options. I may have to change that very quickly. Okay, so let's try November. Maybe I'll just go to January. Use the standard January here for UAL. All right, and so now you have the combinations listed here with UAL at 56.52, the combination of the option that you're selling and the option that you're buying. You can see the max return numbers. And of course, as always, you can choose columns to customize this based on what you're looking for. Interestingly enough, something here, I know we're not going to get too depth into each individual strategy here. What I typically look for if doing any diagonal spread, whether I'm 14 days out, 20 days out, or 30 days out for the position, the short option, and I'm going to the long option, I'm going to look for an implied volatility ratio of greater than 1. I want the implied volatility of the near-term option to be greater than the far-term option. And considering how much speculation there is over the next 5 or 6 months or so of how airlines and maybe cruise ships are going to perform with things opening up, maybe on schedule or not as on schedule as we initially thought, we don't have that. The applied volatility of the January options are much higher than the applied volatility of the July options. So these actually don't match what I would look for an IV ratio, a diagonal calendar spread. But that might be okay again if your sentiment is that this is going to be a growth position over the next few months and you're looking to sell near-term calls against it, similar to a covered call, but without putting all of the high capital in as you would for a covered call position. Now, another feature that we could use, and I'm going to switch over to a cruise line very quickly here. We'll just use RCL that came up. If you are bullish on RCL itself, after you've gone through, you've searched in a strategy you want against the sector that you want, Jeff, and you've narrowed it down to 1 or 2 stocks that you like, and you want to see some bullish opportunities, you can just type it into the top there and click on Search Summary. Now, I might not have all of the bullish ones selected, but what this tool does is allow you to select which strategies you want to view. I've got bull call debit, married put. This looks pretty bullish. Calendar call spread, long straddle, and long strangle. Well, they're speculative. Straddles and strangles are sort of speculative bullish, but in case I'm wrong, I can profit to the downside as well. I'd have to be really wrong. But as you can see here, it's comparing the potential combinations we might have on this stock for certain spreads, default criteria in the background with a potential return. The potential bull put credit spreads, too low of a return on this stock with the probability that it's looking for, unfortunately. Some bull call debit spreads, better structures and better returns. We're going to get to that to Alden in just a moment, as well as the other question via email. And then the long straddle and the long strangle. So this allows you to get a bird's eye view of, protective bullish, straightforward bullish, neutral to bullish, for example. If I had call buying in here, it'd be speculative bullish in that case as well. Speaking of call buying, RCL right now is at $90.09. $90, let's call it $90 even. We're going to go into the signature tools, but you can get here from long call or long put, and I want to use the long option finder. What this tool does is it allows us to put in a stock symbol, our expected price of the stock. So let's just use a 5% increase that we feel that this stock might go up to $94.50, 5% of $90, $4.50. And we want to put about, let's say, $1,200 into long calls. And we think this stock might hit this target in the next 30 days or so, maybe right around or just after standard July expiration on the 16th. Okay, now, what that tool did in that instant is it went out and grabbed every available call option, grabbed call options because I put in an increase from the current stock price. All expirations, all strike prices. And in that brief instant, it grabbed the current price of these options, ran the Black-Scholes calculator to see what these options would theoretically be worth if the stock hit my 5% target in the next 30 days. Now, let me go back to the 15th. I'm going to go back to July 15th. The reason why we didn't see any July series is I selected a date after July expiration. And because I selected one after July expiration, it assumed the Julys would already be gone. So let's shorten this. Do we get any good Julys here? Yeah. So in this case, we have a July 80 call. That's not bad, a 26% return potential. The current cost is $11.50. Well, that's obvious. And it says if the stock's at 94.50, the value of this position would be 14.50. So we'd make essentially a profit of $300 or 26%. Is that realistic? Well, yeah, it's straight intrinsic value, isn't it? We'd be trading right at intrinsic value to have a 26% return in that case. So why are you not seeing these returns that other options gurus out there always promise and say you can make 200% or 300% trading long calls? And it's because your target isn't matched. There's nothing wrong with a 26% return, but you're not seeing a 70% return, an 80% return, because of the target was only 5%. What if this only moved up 3%? Let's say moved up to 92.50 or so. What would we expect returns to be? 9%. This is why I was saying that if your projection, your expectation, Jeff, in the sectors and industries you're referring to are 2, 3, 4, 5% growth in the next 30 to 40 days, you're probably going to be looking at shorter term income. If I expect RCL to maybe go up 10, 12, or 15%, let's go ahead and go 15%. Let's put it up $13 to, let's just call it 104, roughly $104 on that same time frame, or let's say a little bit later, maybe in the next 40 days, we expect it to go up to 104. Now you're seeing the long call returns you'd expect with the longer term series. There's probably not an August series released yet. It'll probably come out after June expiration. That's why we're seeing the Septembers. But there we are at the 88% return, 82% expected returns, more of the numbers that you'd expect with a profitable long call position using that strategy in your account. But again, in order to see those numbers, what are we talking about? We're talking about a 15, 16, 17% increase in the stock in a 40-day period. That's what you need to see those returns on these particular stocks. Lower volatility, unless we also get a spike in volatility where we'd want to see that as well. Okay? So those are the main tools I wanted to share with you. I'm not going to evaluate the individual sectors, of course. I'm not going to go through and give my sentiments on what I think on the airlines or the hotels, what my projection is for their growth. My suggestion is to find more along the lines of a strategy that matches your risk-reward tolerance, the structure that you want to use, and emphasize that if you're going to do the credit spreads, debit spreads, calendar spreads, or even call buying, proper position sizing is key. You don't want to risk too much of your portfolio. I never put more than 10 or 15% of my total portfolio value into bull put credit spreads or into calendar spreads. Because not only on your sector you're hoping is going to move up, but if something happens in the market, and the market itself has one of those hiccup days where it suddenly drops 5 or 6%, your bull put credit spreads, your calendar spreads, you could be looking at 50, 40, 35% losses in one day on those positions. You don't want to have that representing a larger portion of your portfolio. Any position, a long call, calendar spread, vertical spread, leverage positions where you can potentially lose 100% of what you invest in the position really shouldn't be more than 15 to 20% of your total portfolio value, because from time to time that does happen. You don't want to sacrifice most of it just for the idea of using leverage on those positions. Now, we kind of reviewed how I'd use the search and how I'd screen against the filters after selecting which sort of strategy we wanted. I think that's the key. There's nothing wrong with analyzing the performers in the individual sector or industry, Jeff. It's just not the normal approach that Ernie and I use. And I talked to Ernie about it a little bit today too, just to make sure he felt comfortable that I was on the same path that he was on there. So rather than start with the sector or stock, pick a strategy based on the expectations and the outlook. Whether you're more speculative bullish, that 10, 12, 15% for those particular industries, or whether you feel that just in the shorter term, you're going to be looking at a 2, 3, or 4% growth, maybe the next couple of months, hoping everything continues on the way it is. Use the search in that strategy to fine-tune your risk and reward. Add in some of those additional fundamentals and technicals so you narrow that down further. Then screen against the desired sector. If you've decided you found a stock in the desired sector that more matches your expectations, meaning that you feel it's going to be the best performer in that sector, take the strategy you want and use the search by symbol, as I mentioned, for calendar spreads or maybe for debit spreads. Or if you really have that higher expectation for movement up or down, if you think they're going to reverse, a certain sector is going to reverse, use the long option finder, put in the value that's 12, 10, 15% lower than the current stock price, and you'll see which put options would give you the best bang for the buck in those scenarios.